If you like what you see, if I can please request you to subscribe to my channel. So what is an interest rate swap? An interest rate swap is an agreement to exchange one set of future interest payments for another. This typically happens over a certain time period and is based on a certain notional principal amount. Swaps are a broader concept and they date back to 1981 when the World Bank and IBM entered into a symbiotic relationship with each other. The World Bank had reached its cap in Germany and Switzerland, but IBM had a huge amount of debt which was priced in Swiss francs and German Deutschmarks. The World Bank borrowed money in US dollars and swapped those for the franc and the Deutschmark obligation. This is when swaps were born. So what's happening between both counterparties in these swaps? Swaps essentially assist in converting one interest rate basis to another. Typically, in a swap, one side is based on a floating interest rate like the SOFR. The other side of the swap is based on a fixed rate like a spread over treasury bonds. By convention, the fixed rate pair is known as the buyer of the swap, and the floating rate pair is known as the seller of the swap. So what else about vanilla swaps? What's a swap rate? Although there are other types of swaps, the vanilla swap, which is basically exchanging fixed payments for floating payments, makes up the wide majority of the market. The swap rate is simply the fixed interest rate the receiver demands in exchange for the uncertainty of paying the short-term SOFR rate. Are there any risks of investing in swaps? For one, swaps entail interest rate risks. A receiver, that is the person receiving fixed payments, profits if interest rates fall. Conversely, the payer, the person receiving floating payments, profits if interest rates rise. They're also subject to counterparty risk. This is the chance that the other party will default on its obligations. However, this has been minimized thanks to central clearing houses. So what's the final verdict? Interest rate swaps are derivative contracts that trade over the counter. They can be customized to suit each party's needs. Parties are able to exchange interest payments for a specified period of time on a certain principal amount. They are handy for investors, corporate treasurers, risk managers, and banks. They have several potential uses in portfolio management, corporate finance, risk management, or just simply in speculation. So my question for the day is, what is mezzanine debt?